Welcome to the Daily Update. This is being prepared Friday, June 10th, where we'll look at the action in the market today and then see how things look for Monday, June 13th. It was a very negative day, pretty much across the board. The dollar was up, precious metals were up, interest rates were up, everything else, so it seems, was down. When I started out to do this video, it was going to be one of the more executive summary videos. Well, so many charts have changed, it kind of morphed into a daily video update. So it's not quite the same as a regular daily video update. I'm not showing all of the charts, but it's a lot more charts than I would usually include in the executive summary. If you are bullish on the market right now, if you buy low hoping to sell high, there's really only two words you can say: ugly. It was one of those days. So let's go back and talk about what in the world happened on Friday. Right at the open, we gapped lower. That was on the heels of the CPI report, and I'll go into more detail about what happened there. We gapped below S1, which was at 39.84, and even down below S2 at 39.49. So it was really bad. And we continued selling all the way down to 3,900. That was just about where we closed, and that was just about at the low for the day. All attempts at a rebound just failed. Usually when we have a pretty high gap from one day to the next, we see a counter trend move that sometimes can turn into the main move for that day. Didn't even see that on Friday. So there were no really strong rebound attempts. A few tried. There was a little bumping up that took place, but nothing of significance, certainly nothing to change the tone of the day. As the day went on, prices kind of drifted sideways. We tried to get back up to S2, but it just wasn't happening. Into the close, we saw more late day selling, which pushed prices down to the low at 3,900. We ended up closing at the low, so we ended up being down 2.91%, just shy of 3%. It was very negative. Volume was above average. You could say, on one hand, maybe this is more capitulation, since everything got taken out and shot. On the other hand, a lot of the positive things that we've been looking at are pretty much off the table now. So we are across the board negative. Sometimes that means capitulation has taken place, because once we get going in one direction, we often see a move in the other direction. If we do see a move on Monday, we'll have to really keep a close eye on it and see, does it have real power behind it, or is it just a feeble attempt at people who've locked in profits from shorting the market, or those that still want to try to buy the dip only to see prices go even further. The technicals are really negative, and that is mainly due to inflation and interest rates, which is producing growth concerns not only within companies but across the U.S. economy, and we're even seeing that on a worldwide basis now. Of course, all the geopolitical concerns that could easily come into the picture at any time, and then earnings as they are released. Some of the things that we can say: it was a very strong down day. Stocks really tanked. Interest rates and the dollar rose. We also had precious metals bounce up a little bit. The S&P is now down 18.67% from the all-time high. We're not quite into bear market territory on a percentage basis yet, but things are still quite negative. Fear is still really high, but not extreme at this point. This is what caused all the problems. CPI came out and showed a 1% month-over-month gain. They expected it to be at an also very high reading of 0.7%. This was much stronger than expected. Last month, we saw a 0.3% increase. The core CPI, where you take out food and energy, or the things that really matter in life, it increased 0.6% on a month-over-month basis. They expected it to be up 0.5%. We saw a 0.6% increase last month. On a year-over-year basis, the total CPI was up 8.6%. That is big and much stronger than expected. We saw it up 8.3% in April. The core CPI was up 6%, which was a little bit less than the 6.2 that we saw last month. We also got other bad news. Consumer sentiment is just going in the toilet right now. It dropped to 50.2. They expected it to be at 59. Last time we got the final reading, just a couple of weeks ago, we were at 58.4. Now we've dropped way below that. People are just not happy right now on any front that you look at. The condition of our trend, we've dropped below 20 with the ADX, and we have the red line way on top now, so it has a very negative bias to it, but we are below 20. The bias is negative and the momentum is negative. Let's go back and talk about sentiment first. We're down at 28 right now. We could drop even further than this, but we stayed camped below 25 for a long time. People are pessimistic and remaining pessimistic. Here's the historical chart just showing how we finally broke up above 25. It looked like maybe things were getting a little bit better. No, Friday pretty much wiped all that out. The VIX, which had been coming down on a closing basis and looking at the full bar, but it really spiked up. And we're not necessarily at an extreme right now. The VIX of the VIX is also showing a bit of a bounce in the bar as well as on a closing basis. The equity put call ratio just really spiked up. A lot of people were kind of hoping Friday was going to be a good day. There were some setups that looked like if the market wanted to go higher, we could latch onto those and use that as justification to go higher. Those have pretty much been removed now. And our 5-period moving average of the equity put call ratio is also going up and not necessarily extreme right now. This is the other report that came out, which just shows that 2-year treasury yields are just going up. They're up over 3% now. They've really spiked up. How people feel about things has just really tanked down to 50. I think they said this is the lowest reading they've had since 1978 or something. I usually don't like those kinds of readings, but I do remember 1978, and things were not all that happy then. They're not all that happy now. And there's a lot of parallels between the two. When we measure the spread between the treasury yield and how people feel, we are really spiking up negative. Another thing that came out, and I usually talk about this more in the weekly video, is this is the spread between risky loans or high yield loans or different treasuries that we have available. When this really starts to spike up, that's when we get concerned. Just like we did back during the financial meltdown, we did during the COVID plunge, we are going higher. Now, the reason I bring this chart up here is at IsabelNet, they had the same chart, but with a lot more annotation on here. So you might want to pause this and look this over and just see what did the market do as we were getting different readings. We're not really seeing a big increase in stock buybacks. When times are good, when the economy's doing well, that's usually when a company will go in and buy back their own stock. Number one, they're buying stock, so that helps push up the price. Secondly, that removes some of the shares that are out there, making them a little bit more precious or a little bit more valuable, so that can really help a stock go up. We are seeing some buybacks happening, but we're pretty much on par with what we've done in other years. These other lines are just other years all the way to the end. We can only go through the first part of this year on this chart because the information just hasn't been available yet. Another thing, I also try to show the Fed balance sheet. That's the purple area here, and its correlation to the S&P 500. As the balance sheet was growing, we had a little bit of a problem back in 2018, but then we had the COVID plunge. They added all this liquidity to the market through quantitative easing. Now they're starting to stop doing that. Is that going to have more of an influence on the S&P overall? A lot of people are stating that the huge gains that we've seen over the last few years are because of quantitative easing, is because of stimulus that's coming into the market. When you take all that away, what's that going to do to stocks overall? Here's the balance sheet just by itself. And again, I usually show this on the weekly video, and I have figures and things that I put on here, but it's showing that we're starting to roll over as quantitative tapering, or QT, starts to kick into gear. And it has been kicking into gear. This chart from the Daily Shot just shows what do they think interest rates will be at the end of 2022. This is suddenly looking like the good old days right now. They have us at 2.9%. We're well over 3% right now. And maybe we'll come back down. But this chart's a little bit old. Came out on the 8th of June before we saw the shellacking on Friday. Another thing is IPO activity, initial public offerings. In a good, healthy environment, either economically or within the stock market, that's when you see a lot of new stocks going from private companies to becoming public companies, and that's called an IPO. We are seeing a real drop-off in IPO action in 2022. Here's the S&Ps, the dark line. We've been really going down. The new filings, they have really decreased. And the withdrawals, those that said, we want to take our company public, and now we're going to change our mind. That has also decreased, but overall, we're seeing a real decrease in IPOs. The CPI, change on a year-over-year basis, is up 8.6%, and it's really spiking up. Here's another chart. Just since January of 2021, look at how some of these things have really risen. Energy has just gone through the roof. Food is also climbing, as well as services. All items here, everything's going up. This is the shadow stats chart. This time they actually updated it in a timely manner. If we go back to how they calculated inflation in 1990, we would be up at over 11 or 12% right now. That's the blue line. The orange, red, yellow line here, that's the official number that came out. It blipped down a little bit last month. Well, it spiked back up. Now, here's the scary part. A lot of references are made to the late 70s, early 80s right now. If we go back to how they calculated at that time, the inflation rate, we would be up at around 17%. The official rate is 8.6%. So you almost have to double what they're telling us. I went through, just took some screenshots of different headlines that I saw. This is from the Wall Street Journal, Market Watch. Are they going to raise 0.75% where the market is expecting 0.5%? With this blowout report, now you've got a lot more uncertainty, and the markets don't like uncertainty. Bloomberg also saying valuation trauma is refusing to end for the S&P 500 as it's in a free fall. Inflation's at a 40-year high. The Biden team points at the Fed as inflation gets worse. Everybody's pointing their fingers at each other. And this is the worst week that we've had since January. It's just been a rough year all over. But this is fueled by inflation. Also in the Wall Street Journal, inflation pickup complicates Fed outlook beyond June meeting. See, now there's a lot more thrown into the mix. Also, new data suggests public losing confidence that the Fed will actually be able to lower inflation. And this is on the heels of the sentiment survey that came out. In Forbes, $5 milestone, gas prices hit an all-time national high. And that's the average. Here's gas. Even though it came down a little bit on Friday, it has just been going parabolic. Heating oil also getting back to high prices that we've seen before. Diesel, this is the one that's really feeding into inflation as well. It's just continuing to go to the moon, also at 5.7. The different sectors, every one of them was down on Friday, with discretionary leading the way, tech, financials, materials. The one that was down the least was staples, and even that got hit almost 0.5%. Here's how it looks. Going back to the all-time high, energy is way in the lead. Utilities are hanging in there, being positive. Discretionary's now back down over 30% since the all-time high. Technical alerts, it's all red here. Just think of Valentine's Day. Looking at just the S&P specific things, we had a BPI cross below 50, and I have a chart where I'll show you that. We crossed below 4,000. We almost crossed below 3,900, but all of these are negative since they are red. Let's go back and look at what in the world happened. We gapped lower after the report. The report came out about an hour before the stock market opened. The futures had been hanging in there pretty well, and then this report came out and everything just tanked. We gapped below S1 and even below S2. This is not S3. It didn't calculate onto the chart. I calculated it and it would have been way down below somewhere. A good psychological point is a round number of 3,900, and that's pretty much where we hit. We tried a little bit of an attempt to bounce back up. That wasn't happening. And going into the close, we ended up going back down to the low. Here's another chart. I was chatting with someone online, and I was warning them because they were going to go short possibly. And I said, when we have a big gap like this, usually, they try to fill part of the gap. So I said, be careful of that. Don't short the market right at the open. That's usually my own philosophy. Well, on Friday, that would have been a good thing to do. We didn't even get back to where we opened on Friday. So this gap was not filled. Looking at this on a daily chart, first you'll notice that we did see above average volume. We saw the real gap down below the long-term support. We're now down below the pivot. The next stop on this chart is at about 38.59, where we have the monthly pivot for S1. Then we have the lows that we set back in May. That could be another support level. Nothing has changed. The things that were positive the last time I did this video continue to be positive. And the things that were negative continue to be negative. So this hasn't changed. What's changed a lot are some of our charts. They switch from being neutral to negative or being positive to negative. So let's go back and look at the trend. The ADX is trying to turn up now because we saw a real strong spike with the selling, but we continue to be below 20. We're starting to cross the moving average. If you're a little bit more aggressive, then you might consider this to be a trend once we cross the moving average. If you're a little bit more conservative, then you might wait until we get back above 20. Looking at breadth, this is pretty negative. We had a couple of down days in a row, back to back, and we might be extreme negative on a short-term basis. Also, looking at the new highs and new lows, we're getting down to an extreme reading, but we could go much lower than this. Our new highs and new lows were one of the positive things we were watching. That's now switched over to negative. The advanced decline line, we did have a bullish divergence. We were using that to justify prices going higher. That's not necessarily off the table now, but it's really in danger of being a false signal. Here's the new highs and new lows. They had been trending higher over the last 5 periods. They had been going up over the last 10 periods. Well, everything switched to down after Friday. Accumulation distribution had also been hanging in there above the moving average, but now we dropped below. And then those stocks that are above their 200-day simple moving average, we're starting to get back down to where we bottomed out before, but we could still go lower than this. This isn't necessarily climactic on this chart, but this is longer term. So let's go through and look at some short-term charts. On a one-day basis, we overdid it. Prices really fell compared to the previous day, so that might at least slow the selling down, if not produce some kind of a bounce. Going back 5 periods, we've also hit an extreme negative reading. We're well below all of our moving averages, even in the shortest term rainbow. McClellan oscillator, it had been extreme positive. Now it's shot all the way down to extreme negative. Stochc RSI, also extreme negative, as is the Williams %R. Our moving averages have also gone to extreme negative with the 20 and the 50, and they're now declining on the 200. Short-term stochastics, which seem to be permanently lodged in the overbought condition, have now gone to oversold in the short term. We're declining intermediate term, and we're starting to go back down in the longer term stochastics. Intermediate term charts. All of our momentum oscillators are showing some weakness now. The slope and the MACD are starting to cross back over negative, where our longer term oscillators like the KST and the TRIX, they're turning over a little bit. The PMO is rolling over, and the TSI is almost ready to go negative as well. The bullish percent index, this was the alert that we saw where it dropped below 50. It had hung in there for most of the week. Well, with Friday's action, it really dropped negative. The PMO, as I said, is starting to roll over. It's already crossed over based on price and volume. The PMOs that are rising had been extreme positive. Now they're extreme negative. The buy signals are starting to decrease, and the percent that are above zero is starting to decline. The CCI for 14 periods is extreme negative. The 20 period is not quite there yet. The Sean trend meter is extreme negative. The rate of change on 50 periods, so that's more intermediate term, it's switching to extreme negative. The boom indicator, looking at 50 periods, we're quite a bit away from the 50 period moving average. When you look at the 200 period moving average, we're far away again. The Connors RSI is also starting to give us an extreme negative reading. And the triple exponential moving average as well as the double, we're well below both of those. We're still above this anchored moving average, but we're in danger of dropping below that if we see further weakness. The TTM squeeze is showing a decline, but it's still positive, although it's dropped below this other anchored moving average. Our different charts have switched over to pretty much negative. The Heiken Ashi is now negative. The Kegi is red, so it's negative. The Renko is drawn in a red box, it's negative. The point and figure chart is not generating a signal, but we do have 3 zeros drawn in here, so that is negative. The 3-line break has a big, thick, dark candle now. Our different trading systems, the Elder system on the S&P is now negative, as it is for the SPY. The SAR has added a dot on top, so that is now negative. The Go No Go system has switched back to the darker purple. That's also negative. Our longer term charts, we're well below the 200-day moving average, so I didn't even show that. We're declining with the 50, 150, and 200. We're starting to break below some Fibonacci support levels. We had stayed above this for quite a while. Well, with Friday's move, we dropped down below that. Now we're looking at the next fib level at about 38.25 to 38.29 or so. The weekly chart could also be showing us some weakness. This was the low that we set back in May. We're in danger of coming back down to that level. The question is, can we bounce up from here? If we come down to this level, are we going to be able to bounce up? If we drop below this, that's when we go into a bear market. Looking at some other markets, the diamonds are decidedly negative. I mean, look at this gap. You don't generally see these huge gaps with index ETFs. The same thing is true with the NASDAQ 100 or the Qs. The Vixen really popped up, both on a bar chart as well as on a closing basis. The small cap ratio, they actually did a little better than the S&P did. So on a ratio basis, it spiked up almost 0.5%. The dollar, as stocks have been going down, the dollar has been regaining some weakness. So when we go to this next chart, okay, are we coming down? Which is what the initial thought was, but we're now starting to go back up. Looking at the dollar compared to the S&P, we have the dollar going up and the S&P going down, so they have a pretty strong inverse relationship right now. Oil, it actually declined a little bit on Friday. It went down with everything else, but we're still above 120. And here's the correlation between the S&P going down and oil. They have a fairly strong inverse relationship currently. Bonds really took it lower based on price, which means interest rates really went up. And we have the 10 to the 5. It's still inverted, even more so than it was before yesterday. And now we have the 30 to the 5 year. It's also going inverted. So things really got out of balance on Friday. They took it to the extreme. We'll see if this readjusts. Looking at the correlation between the S&P, which is going down, and interest rates, which are going up, they have a pretty strong inverse relationship. We're getting near this upper resistance with the 10-year Treasury yield. Will we break through and go above that? And here's tech, which has really been getting hit hard. That's the black line. And the 10-year yield, it's been going up, so they're also in a pretty strong inverse relationship. The 30-year yield, we're starting to break above 3% with that as well. And this had been a fairly good level of resistance before. Well, if we break through, now we're looking at possibly going much higher. Junk bonds were down, just like the stock market was. And on a comparative basis, they actually underperformed bonds. But overall, they are in an uptrend. That's why people are seeking a higher rate of return. They're willing to take on more risk to get a higher yield. That could produce a lot more risk to their portfolio. Here's the chart of all the US yields just going up big time, pretty much across the board. Here's internationally. The US is on top. The UK rates are really skyrocketing up, as is Germany, but Japan's just kind of trickling along sideways right now. Looking at our intermarket analysis chart for the week, oil, even though it declined recently, is still performing the best, followed by the dollar. Gold is still barely positive since the beginning of the year, where stocks are declining and bond prices have been declining. Our possible positive scenarios, not a lot to look at. It looks like we're now spiking up again with the 2-year yield. This other spike that we had been watching looks to be being replaced by another spike. And here's the correlation between the 2-year yield and the S&P. The yield is really going up as the S&P is going down, so they have a really strong inverse relationship currently. The small caps really went down, but not as much as the market overall, so they perform better. And we see a little bit of a spike right here. Is that going to help the S&P? We were actually looking at another spike, hoping that that might push the S&P higher. Well, that seems to be off the table now. What we're looking for is a continued show of strength on a relative basis with the small caps. Can that give some support to the bigger S&P 500? The staples were down, but only less than 0.5%. So this looks to be producing possibly another spike. We're still working off this main spike. And you can see in the past where it looked like where we did make a spike and then we came up again. So right now it's not necessarily in danger, but we're just not seeing any follow through with the S&P 500 based on price. So what's our outlook then for Monday? The technicals are negative, and short term and even a lot intermediate term, we're oversold because we saw a massive decline. Sentiment is still quite negative, but not necessarily extreme negative. The growth and value battle, they both got taken out and shot on Friday. The economic reports, there's none coming out on Monday. Geopolitical events, these are the same. Russia, Ukraine, supply chain, inflation, that's the big one for the markets. Oil, earnings, Fed speak, they seem to be a lot more hawkish now instead of this idea that inflation has topped and is rolling over. That was pretty much wiped out on Friday. And then the longer term situation in Japan. So our different scenarios, we're not necessarily negative right now because the ADX is below 20. So that's why I have this in white and all the reasons that I just talked about. And if we do see a bounce, look for some selling into strength. That could push prices down even more. Because you've got this buy the dip mentality that a lot of people will never seem to get rid of eventually until it just wipes them out. The technicals are strongly negative. What could help us go up from here? The technicals are really negative and just a disbelief that the market can't go back up. And sometimes that produces a reverse psychological effect. Our possible positive scenarios, yeah, we still have signals from all of these things. The Copic curve, which I didn't show, the Pring bottom fisher, but these are starting to roll over a little bit. They're not going to last if we continue to fall. The staples, it still looks okay, but it might be spiking again. The 2-year yield keeps going up, so it hasn't topped. And the Fed pivot, no, they're still maintaining a pretty hawkish stance. And then the technicals are not really helping either. So we're looking at possible daily pivot points. We try to get back to the short-term moving averages, the fib retracements, which may act as support, previous levels that we might hit. We're looking more at support right now, not necessarily resistance. And then sideways, this is where we're at because the ADX is below 20 with a strong negative bias. So our conclusion then, not hard to make. The S&P is negative, short-term negative, and possibly short-term oversold. We could even make that case for intermediate term. It's negative and looking a lot weaker than it was just a few days ago. long term, we were negative and we maintain that negative stance. So thank you. Have a really good weekend. I will prepare the weekly video as well as the intermarket analysis video and post those as soon as possible.